not everybody's financially mature, and some people have to learn the hard way, unfortunately. If it's keeping you up at night, you're thinking about it, and yeah, it's to be smart about it. In my opinion, a HELOC would be a good option right here. If you have a lot of high cost consumer debt, find a solution and fix it, right? Change it. You got to make the change early before it's too late. Because I see a lot of people coming to me when it's way too late. They've already
What
maxed.
do you mean by too late? Can you clarify what you mean by that?
So they've already racked on more like $1,400 a month. But then they have like two
Mm-hmm.
cars that are like $1,600 each or total. And then you got credit
Mm-hmm.
cards and
Mm-hmm.
personal loans. And then it's like, wait, you went from a housing expense of $1,400, but you ended up choosing to have two cars, $1,600, credit cards for $500, and then personal loan for like $800. And it's like, how is that possible? How did you go from $1,400 a month housing to like three grand or more on consumer debt? Like, what was the reason for that? That's what I'm talking about. It's like you need a budget because, like, I wish. I mean, it'd be more work, but depending on the person, like when I talk to my clients, I want to know what their long term goals are. Do you want to just buy this house? Is this your forever home? Is this something you're going to step into? Then it's like we start having like we draw the picture for each other so we know where you want to be in like 5 to 10 years, right? If it's your
Mm-hmm.
forever home, then yeah, we're going to start talking about like what's your plan for retirement? Have you been saving? I'm not a financial
Mm-hmm.
advisor, so I can't give you guidance on how to do it, but I always
Right.
like to better understand so that like if I talk to you 6 months later or a year later and I tell you, hey, it's a good time to refinance because the rate drops, it makes sense because I know what your long term goals are, right? Because it's going to end up putting you an extra $500 in your pocket each month to put away for retirement that you didn't before.
Mm-hmm.
But I see some people take that other way and then they take the savings and they end up spending it, and then it compounds even more. It's like you were in a 30-year mortgage, you reset the clock and you're in another 30-year mortgage, and then you're blindly saving $500 thinking you can spend that $500. It's
Yeah.
me personally, I prefer to see my clients pay less in interest for the long term. So it's like if you're going to do a
Yeah.
HELOC, it's like you're going to hear from me in some cases like, are you really going to make that extra payment, or are you going to give yourself the 15-year option and put like the guy on Dave Ramsey just said, are you going to go with that 15-year option to make sure you make that payment so you're not wasting your money on interest and actually paying
Mm-hmm.
down that debt?
Yeah, that's a good point. Like my wife and I, we do a yearly budget meeting. It's a lot of work. I prefer to do it manually. I know there's programs out there that, um, you just plug in your statements and then they just organize it for you. But the reason why I do it manually is because I want to feel the pain of seeing everything that I spent my money on and just like I need to internalize that for like a few days, and then having that memory of that, like, oh man, why did I do this? Why did I do that? That stays with me for a year, and it helps me to rediscipline myself because there's like, I know you need a reward system, right? You have to like hack your brain somehow to grow. And we go through this exercise every year, and we have our goals, like what kind of vacation do we want this year? And so like and whenever that temptation is there to you know um, buy that extra coffee that wasn't really in our budget, I always think to myself, okay, am I willing to steal from my future self in this moment? Like that's how I frame it in my own head. I'm stealing from my future self. And then even more, we have kids involved, so like what we're doing to build our wealth and our future financial planning is to set them up for the future, right? So really, I'm not just stealing from my future self, I'm stealing from my future kids. And so when I frame it that way, it makes it more like, okay, the stakes are higher and I have to manage this wealth, this money that I have, this limited amount that I have, as best as possible.
Hmm. No, it makes sense because you are stealing from your future self.
I think this is the point of the show. Like we're trying to help our audience to make good financial decisions. And,
Mhm.
just because you qualify for a mortgage and a loan doesn't necessarily mean um, you're going to be able to pay that mortgage and be responsible for the life of the loan. The 30 years is a long time, right? And there's a
Oh, it
lot
is
of things you can
100%.
screw up in those 30 years, right?
Mhm.
Like you've seen foreclosures, you've seen people default and file bankruptcy. Like, people make bad
Yeah.
decisions if they're not
It
careful.
life happens, and you're one misstep away if you're going in that direction, like you're talking about financially. Like if you're not paying attention to the consumer debt and long-term planning, you're literally one like one missed paycheck away from bankruptcy, which is nuts. I like what you said about doing it manually, because it's like I started smiling to myself, because like I do the same thing. Like I literally have everything in Excel, and then I'm like
Uh-huh.
looking at it, and I'm like, what was this? Where did this come from? I'm like, oh
Yeah.
wow, that was a surprise change to the
Uh-huh.
monthly expenses. What happened here? That makes sense.
Yeah. Money is fickle, it flows towards people who pay attention to it. So if you're not paying attention to your money, it's gonna stop paying attention to you. All right, let's keep
But
going.
smart things on autopilot.
Yes. I don't want
Like
to think about it.
100% of the 15-year mortgages pay off in 15 years
Mhm.
or less.
Yep.
100%, or they get foreclosed on. I mean, 100% of them do. Okay. People that take out a 30 promising to pay a 15, the studies say
Or they
92% do not.
Yeah, 401ks are successful because you don't see the money. It's just it built in delayed gratification, right? So
Yeah,
just wow,
100%.
that's such a interesting and almost like a sad view of consumers and people. It's just like uh, the assumption is you're gonna be irresponsible with your money, so just protect yourself and don't let yourself see it.
It is, but some people need to do it that way because it's so
Yeah,
hard right now to not go online and be bombarded with ways to spend money, right? Or
right. Uh-huh.
like the old saying, like they were saying, like keeping up with the Joneses. You that was
Uh-huh.
because you would literally see your neighbor, right? But now it's
Yeah.
like everything looks great and everybody's on this beautiful tropical vacation into some weird country I've never heard of,
Yeah, yeah.
with their
It's not just
family.
your neighbor. It's like literally the 1% is right in front of your face.
Yeah, it's you just got to be smart about it. You got to budget. But the thing is, he was talking about automation or something, right?
Yeah, what's your take on that?
If you're trying to automate it, you have to be in a place where you're financially stable for that to really work, right? So you can't put yourself into a 15 year if you're not financially able to support that, right? And if you don't have a budget in place, how are you going to automate savings and putting like making sure you put 20 or 30% away for a rainy day?
Do you think about like if you're on an adjustable rate, you cannot put it into an automation. Like you need to pay attention to that, right? Because once the rate changes, and that
Mhm.
just screws up your entire budget.
Kind of, kind of. It's like it depends. Like adjustable rates have a really bad rep from back in the day,
Mm-hmm.
like with the financial crisis. But it could be a right tool for the right person. So that's a product that's a very niche one. Like how you'll say like 92% of people don't make that extra payment like they said they would on a 30 year.
Mm-hmm.
And only 8% do. It's like 1% of the people that have adjustable rate mortgage will do exactly what it's designed to do. You know,
What is
so
it
it's like
designed to do? Can you tell the
it's designed
audience?
to give you temporary relief to pop in a low rated market where they give you a lower payment. Right, you're not meant to stay in that mortgage.
Mm.
Like you're selling that house or downsizing or refinancing for certain within the next three
Before
to
the rates
10 years,
adjust.
whatever before
Yeah.
the adjustment period ends. Like
Yeah.
you when you bought that house, you're like, okay, I'm only staying here for like max 5 years. So that's why I went with the 7 or 10 year arm because it was
Mm-hmm.
the lowest rate possible. And some people did that strategically, right? Like there was a time period where I was seeing advertisements for on a 30-year 10-1 arm with
Mm-hmm.
one of the bigger banks at like 2.25, right? And then you see like interest rates down 15, down under 2% at like 1.75, 1.5.